Hi, I'm Brian Daingerfield, the co-head of G10 FX Strategy at NatWest Markets, filling in for John Briggs. The first quarter of 2022 is now behind us, and to say it was an eventful quarter would be a huge understatement. Inflation risks continue to dominate the global landscape and have pushed global sovereign debt yields decisively higher. Central bank responses to that higher inflation has also opened up significant policy divergence among major economies. The Federal Reserve has made several decisive hawkish shifts in the first quarter of 2022, and the ECB made a surprising hawkish turn as well. More recently, the Bank of England has sounded a bit more dovish, and the Bank of Japan is on the other side of the coin, pulling out all the stops to defend its ultra dovish yield curve control policy. Of course, Russia's invasion of Ukraine in February has also exacerbated both downside growth fears and upside inflation risks, bringing with it a heightened sense of stagflation risk across major economies. To break down this eventful quarter and to highlight what to expect in the coming quarter, I'm happy to be joined by my co-head of G10 FX Strategy, Paul Robson. Paul, given all the factors I mentioned above, I think it's notable that Eurodollar is just only about 2.5% lower since the end of 2021. Can you talk about how you're seeing Eurodollar here, and what do you think some of the key drivers ahead are as we look ahead to the second quarter?
Yeah, thanks very much, Brian. You say it was noticeable that Eurodollar sort of held up. I go a little bit further on that, saying I think it's really quite surprising given the fundamental backdrop that we've seen in Europe, especially in terms of the repricing of front-end rates, much in favor of the dollar, and relative growth expectations as well. Maybe they need to go a little bit further, but we know that financial markets discount the future sort of today, and it's a surprise that Eurodollar hasn't moved, because those are two important traditional drivers of Eurodollar, both rates and relative growth. If you think about Europe, I think the story is increasingly well known, but downside risks to growth on sanctions, self-sanctioning, cost of living, food prices, energy prices, all weighing on growth, and a central bank that sort of reacted to that a little bit. On the US side, it's, as you know, Brian, it's just a good story that keeps on getting better in terms of growth, and on a central bank where markets continue to price in ever more tightening. In terms of some of the drivers that maybe are outside of those two drivers that I've mentioned, maybe it's just investors have been, quick to want to buy into the positives of any developments around Ukraine and Russia. Perhaps there's some sort of corporate flow that's hard to identify, because at these levels, we think it should be lower, but 110 traditionally is sort of towards the bottom end of the range, and maybe people are repatriating money. And equally, ECB tightening expectations relatively soft, but they may be asymmetric. So when rates get up past zero, investors who aren't able to hold zero or negative yielding assets might be able to bring back money back into Europe. In terms of the drivers going forward, we think relative growth and rate expectations are going to be important. But the key takeaway that I would leave people today is that we do still see a window for Eurodollar to make fresh cyclical lows. We just think it's starting to narrow a little bit. And one way of looking at that is just looking at Eurodollar relative to the slope of the US curve, and the Fed tightening cycle, even though it's sort of only just begun, feels a little bit late cycle. But short term, we think that weakness persists. Just a few points here. The Ukraine situation, we still remain cautious on that. Balance of payments deterioration, we think that that's going to be important. And again, markets might, that move to zero interest rates still quite a long way off. Later on in the year, upside risks for Eurodollar start to build as the Fed becomes finally fully priced, and that growth slowdown in Europe is fully seen by financial markets.
Thanks, Paul. You brought up a lot of good points, and one on the US, which I think is super interesting to see, is this dynamic of, are we late cycle perfectly priced? Despite the fact the Fed has only done one 25 basis point interest rate hike, we're already seeing inverted curves this early in the cycle. It'll be interesting to see how the dollar reacts to shifts in Fed pricing now that the market already has inverted curves and we're sort of flashing the sort of stagflation recession style risk that the market tends to associate with inverted curves. So I'd like to turn over to sterling now. The Bank of England, as you know, came into this year as likely to be one of the more hawkish central banks. And, to an extent, they had delivered on that early in the year. But the recent cost of living shock has them singing a much more dovish tune of late. And euro sterling is actually trading close to its 2022 highs as we come to the end of the first quarter. What do you think are some of the key dynamics for sterling, and how might that differentiate from the euro?
Well, I think in terms of the drivers of sterling, as you or regular watchers might recall, we've actually been positive on sterling because of a relative growth story and a positive Bank of England support for the currencies you mentioned, Brian. But those have started to weaken as key supports, and we actually took profits on our long sterling positions ahead of the March Bank of England policy meeting, because we saw this cost of living crisis just making the Bank of England, just step back a little bit, be a little bit more cautious, because obviously there's going to be an impact on real disposable incomes, on real growth, and depending on how long it persists, an inflationary shock that's done by supply side can ultimately be deflationary, and therefore central banks can look through it. So the outlook for sterling has darkened because of that cost of living shock and because of the Bank of England stepping back a little bit. In terms of the drivers and things to watch for sterling, well, it's going to be how events play out in Ukraine, because that's causing the cost of living shock in Europe and caused the Bank of England to sort of rein in its hawkish guidance, and that's taken the edge off sterling. We're still watching relative growth in the UK. I know that I've mentioned it for the euro dollar and for sterling, but personally, I think it's a key driver of portfolio flows, and we need to watch that. And of course, how resilient the UK economy is and the consumer's ability to continue to spend when they're facing higher prices. Now, the UK economy actually started the year in really quite a good position, and if it wasn't for the slowdown caused by the crisis in Ukraine, the Bank of England would maybe even talking about hiking in 50 basis point hikes, just like the Fed. So we'll be watching that. And the final thing to watch for sterling is seasonals actually turned surprisingly positive in the month of April, which is obviously we're just about to move into. So maybe sterling holds up relatively well against euro and sterling, against the dollar in the coming month, but the outlook looks to be getting a little bit darker, as I said earlier. Maybe sterling euro risks bias to the downside in the second half of the year as the euro also starts to recover.
Great, thanks, Paul. Turning to my side of the Atlantic quickly, the dollar had a mixed quarter overall, and one of the real differentiators between outperformers and underperformers against the dollar has been commodities, where you stand on the commodity exporter or importer stance. And this was a 2022 top theme of ours: resources prove resourceful, trying to favor commodity producers against commodity importers. So antipodians, for example, are among the outperformers, even with the traditional risk off that is the Ukraine crisis. And oil importers and energy importers more broadly in particular have been underperformers, and that includes the yen. We've had this period where risk has been shaky, volatility has been higher, equity markets have held in, I would say, but the yen has weakened pretty substantially. Just as early as this week, actually traded above 125 for multi-year highs. We think the key factors to watch for that pair are going to be energy prices and interest rate differentials. Japan's current account and trade dynamics, which tend to be big supports, it has a very strong positive current account surplus. Those have worsened recently because Japan is a net energy importer and energy prices have surged while the yen has weakened. So energy prices denominated in yen have increased substantially. That might be one of the reasons why the yen seems to have lost some of its safe haven luster of late. Additionally, BOJ policy has really contributed to widening differentials, particularly against the US. So you have US yields and global yields have been rising, but the Bank of Japan has been taking forceful action to defend its yield curve control policy, which anchors its 10-year yield. So as we think about the next quarter for dollar yen, we think about oil price and energy price volatility. That's likely to be a feature of the outlook as long as the Ukraine crisis continues. And we have to think about relative interest rates. And in the long end, I think it's important here to note that our US rates colleagues are actually more neutral on the long end of the US curve now, essentially saying, look, there's probably more room for the front end rates to move up as the Fed, we continue to price towards more aggressive Fed in the near term, front loading of those risks. But to the extent that fuels concerns about stagflation and perhaps lower growth down the road, that might mean that long-term yields are more stable. So if we think about 10-year yield differentials, if 10-year yields start to look a little bit more stable here, that could be a stabilizing factor for dollar yen and maybe help arrest the free fall that we've seen in the yen over the last couple of weeks. So with that, thank you very much for joining me, Paul, and thank you very much for listening, everyone. If you enjoyed this podcast, please be sure to like and subscribe. Thanks.